Hi everyone, Kessa Simi here, the mortgage broker and property investor. So I wanted to give you a mortgage market update today, and it kind of ties in well with the Monetary Policy Committee. This has obviously just had their meeting, so I'm going to be discussing that too. This is a live and interactive call, so if you do want to ask any questions, feel free to leave them in the comment box, or if you even want to jump onto the call, you can do that too. So maybe if you've not heard from me before or not aware of who I am, I'm a mortgage broker and property investor based in Scotland. I specialize in helping property investors grow their portfolios. The majority of mortgages that we do are for property investors, and I too am a property investor, so really kind of walking in the same shoes as you guys are. So obviously the big news today is the interest rate the base rate has been increased by another 0.5%. Wasn't really a surprise, especially for the lenders. But it's confirmed that it's now at 3.5%, was previously at 3%. It's now at its highest level since 2008. Interestingly though, so out of the committee, six of the members, they voted in favour of the 0.5% increase. Two of the members actually voted for a 0.75% increase, and one member actually voted just for it to stay at 3%. So it maybe kind of shows a shift there, and how much they're potentially wanting the rates to increase by. And obviously, the main reason why they're doing this just now is to bring inflation down. There is kind of some reports now that inflation is slowing, so that's positive news for them. They don't obviously want to overshoot the mark and increase rates too much, but ultimately it does look like we're going to be going into recession now in quarter three. The market did contract by 0.3%. And potentially is looking like it's going to contract again in quarter four. And if that's the case, then technically we will be in a recession. Previously, they were suggesting that the base rate might go up to 6%, but now they're forecasting it to go up to around 4.5%. But this is ultimately just predictions just now. It could be lower or could be higher than that. But it's worthwhile knowing, especially when we kind of move on to the next slides and what that could mean for yourself as a property investor. So for the mortgage market update in December, what's been happening? It's been kind of a turbulent couple of months, to be honest. Off the back of the mini budget, who's now the previous prime minister, and Kwasi Kwarteng, when they put that in place, obviously the lenders or the markets didn't like that. The cost of borrowing increased, and because of that, then the lenders had to remove all their products, reprice them, and bring back new products that were much higher than they were previously. So it's been a difficult couple of months, but the good news is that the market has settled from that. We've started the current trend is that we're seeing rates starting to reduce with the majority of lenders. And before we was getting updates daily, rates were increasing. Now it's the opposite. And even today, we know off the back of the news with the base rate increasing, lenders have still continually updating us, saying that they're continuing to reduce their rates. So overall, I kind of see that as a positive. Product availability, that's been a worry for some. And it was an issue a couple of months ago, but all the lenders are back to lending, pretty much at sort of full capacity. There's still a couple of lenders that are, not offering their full mortgage product suite, but most of the lenders are now back to lending at 100% capacity. One of the issues that we've had off the back of these interest rate increases is the mortgage stress test for buy-to-let mortgages. And just to cover off what buy-to-let mortgage stress tests are, it's basically where the lender needs to see that the property will basically cover the mortgage payments, not just at today's rates, but potential future higher interest rates, and also taking into account a coverage ratio for any void periods, tax, and any other sort of costs involved with running a buy-to-let. Previously, the lenders were stress testing these mortgages at between 5 and 5.5%, and it's pretty much the same across the board. Because a lot of the mortgage products were priced higher than that, all the lenders were having to make up their own stress tests. Some were bringing out really kind of quite strict stress tests, at so 8-9%, whilst others kind of done something in the middle between the 5% as it was before and kind of the higher levels. Some were just stress testing at what the pay rate would be. So basically, whatever product you're taking out, you'd be stress tested at that product. But also, some of the lenders have actually kept the previous stress tests as well. So it's been a mixture across the board, and really, what that's kind of how that's property investors is um, the way that some of the lenders are stress testing is making it quite difficult for low yielding properties, especially if they are in your personal name. So sometimes if you, let's say if you've got, for instance, a property at 200,000 and it's got £1,000 rental, previously that would typically be fine in personal name, but now with a lot of the lenders, we're struggling to place these sort of cases. So we're finding a lot of clients are favoring high yielding properties, not just for that reason, also because interest rates have been increasing as well. So on these low yielding properties, there's very little cash flow now with the higher interest rates. That's something to bear in mind. At the same time, though, it's kind of knee jerk reaction from a lot of the lenders, and they've kind of seen that. If it's not working, they've kind of revised this down. And just recently, TMW just said that they're going to reduce their stress tests again. A lot of other lenders have also started to reduce their stress tests, and I think that will be a continual trend going into 2023. So I wanted to discuss variable rate mortgages as well. These have become more popular. Was quite popular previously, but over the last few years, fixed rate mortgages have been kind of the go-to product for most property investors. Generally, they've been actually even cheaper than variable tracker or discount rate mortgages. But now with the volatility in the market, we've started to see a lot more lenders offer these products and a lot more clients actually wanting to go for them sort of products. So what are they if you don't know what they are? It depends on the product. Like, so a variable or a tracker rate mortgage generally will track the Bank of England base rate. So the base rate's obviously gone up today. So if you was taking out a product that was a tracker product, then that potentially would also go up. Usually it will track the base rate by a certain percentage. So let's say it was 1% above the base rate. With the base rate now being 3.5%, your interest rate would be 4.5%. But it could also go down as well. The benefit for with these products just now is that for the fixed rate mortgages, they're having to price in the volatility over however many years that you're taking that fixed rate mortgage out for. It could be 2, 3, 5, 7, 10 years. And then because of that volatility, they're unsure where interest rates are going to go to. They're obviously having to add a considerable margin on top of that. So that's why fixed rate mortgages are considerably higher just now. Whilst with the tracker rate mortgages, they're just really needing to price in the cost of borrowing today, as long as there's obviously that margin above. And then if the base rate does go up, then it will increase in line with that. The discount rate mortgages have also become popular. Not all lenders are offering these, and also not all lenders are offering variable rate mortgages either, or tracker mortgages. But a discount mortgage is generally where it's a discounted rate off the lender's variable rate. So often you'll see the variable rate for a lender when that's the rate that you'll go on to once you come off your initial rate, which is usually obviously significantly higher than what your initial rate was. But this is often these discounted products are a discount off that. So it might be like, say, 3% discounted off the lender's the variable rate. And if the variable rate's at 7%, that could be 3% off that, just to give you an idea. Often we find that these don't move as often as the tracker rate products. So just because the base rate's gone up today doesn't necessarily mean that the lenders will change their discounted or their variable rate. So it could also be another option for you just now. One of the other main benefits for going for these products just now, they tend to be shorter term products. Most of them are for 2 years. Some of them have no exit penalties whatsoever. So if you used to take a mortgage out and then if the market changed, and you wanted to move on to a fixed rate mortgage, you're able to do so without paying any exit penalties. Typically, if you took out a fixed rate mortgage, there would be exit penalties to pay, which are higher in year one and reduced depending on how many years you take it out over. So these offer you more flexibility. Some of them still do have exit penalties, so bear that in mind. Not all of them have no exit penalties. Some of the lenders now are offering what's called like a switch to fix or a track to fix as well. So basically, if the base rate continues to rise, or if you're worried about the volatility on your tracker rate product and you want to move on to a fixed rate mortgage, you can do with that same lender. As long as there's no arrangement fees with the new product, you can move over without paying any fees. So it gives you that flexibility. And ultimately, because the lenders are having to price in this volatility for the fixed rate mortgages, if they know if the fixed rate or the base rate starts to stabilize, we might see the fixed rate mortgages start to go back down as well. I'm getting confused with all my wording here. We might see the fixed rate mortgages come back down as well. And then if the differentiation between the two isn't that much, some clients might actually want to go on to fixed rate mortgages instead. And lastly, on these sort of tracker and variable rate mortgages, they were a lot cheaper before, around 2 months ago when there was all that volatility compared to the fixed rate mortgages. But we have seen the fixed rate mortgages come down significantly recently. And at the same time, some of these variable rate mortgages have increased. Some of them, it's the margin above the base rate that's increased. A lot of the times just now, the setup cost to arrange them has also increased as well. So although they might not charge you anything to exit the mortgage, there might be initial fees to pay to set up the mortgage. So ultimately, there is a cost in setting up that finance. Another question that's kind of been quite common over the last couple of years and has potentially affected us as property investors is how busy the lenders are, and how busy are the lenders currently? Well, from a client's point of view, the good news is they have started to slow down. They are still quite busy, depending on the lender. Different lenders are at different sort of capacities just now, but a lot of lenders have quietened down. And what knock-on effect that I think that will have to us as property investors is that kind of going into next year, we will see a lot more flexibility. But I'm going to cover that off and my predictions at the end, actually. But ultimately, just now, we're starting to see timescales reduce, especially over the last couple of years with COVID and what's been going on. The timescales have been really stretched out, and purchases and refinances have taken a lot longer than they typically would take. So with the lenders being quieter just now, you know, properties or mortgages are going to offer much quicker than they was previously. So you might have mortgages just now. It could be your personal mortgage, could be buy-to-let properties, and potentially coming up for a remortgage in the near future, and worried about what interest rates will look like then. And what we're doing with our clients is approaching them typically sort of 6 to 7 months in advance to make them aware that first their interest rate is going to be finishing, and then what options they have available. And really at that time we're kind of discussing with them to see what the future plans is for that property. If the future plan is to sell that property in, especially within a sort of short time frame, then they might want to go on to the lender's variable rate, or maybe look at some of these tracker or discount rate mortgages. If they're looking to vary the terms on the mortgage, that's something that clients are sometimes looking to do, borrow more. But often, more often than not, just now, a lot of clients are happy with their current mortgage terms and just really looking for the best rate possible that they can get. And generally, most of the lenders just now are offering better products for existing clients than they are for new clients. So, I mean, we always do kind of like a whole of market research when we're looking at the client circumstances, but the majority of the time, just now, we're finding that the existing lenders' rates are better than remortgaging to another lender. The benefit from you, from a client's point of view, is that there's no underwriting being done. You can just move on to a new product with that same lender. It's quite seamless. Typically, it will kind of be put in place when your previous rate finishes. Depending on the lender, you might be able to apply up to 6 months in advance. So with some lenders, we are able to do that just now. And with that sort of the fluctuation in mortgages, I mean, like a couple of months ago, it was preferential to do that when interest rates were rising. Now with interest rates dropping down again, we're also kind of looking at that market. Some clients are wanting that stability to go for that product. Some lenders are also offering you the option to be able to fix into a product or lock a product that you want just now. But if a better product does become available within that time between now and when your product is due to start, you can move over to that better product as well. But on the other side, if the rates get worse and they do go up, if you've already locked in the product, then you know that's secure. So there is some flexibility there just now. And I think the key thing there is maybe just look at your end dates on your mortgages, diarize them, and ideally you want to be sort of exploring your options around sort of 6 to 7 months before. And what are our clients doing? A lot of people are asking me, what are our clients doing just now? So I kind of covered, a couple of options there. The majority of the clients are kind of going for product transfers, which is going for a new mortgage with the existing lender. Some are holding off because the interest rates have been quite high, but again, because they are starting to reduce again, clients getting back in touch with us and saying, can we review this again and see what rates are available? If the rates are now acceptable to themselves, then they're going for new products. Sometimes we're keeping an eye out on our clients' properties and sort of profile, and keeping an eye on the lender that we think might be suitable with them. And as we see kind of the rates starting to drop with that lender, we're then getting into contact with them at that point. In regards to products that clients are going for, so it's a mixed bag just now. Some clients are going for these variable or tracker rate mortgages because they feel like the base rate is only going to go to a certain level. I mean, the Bank of England are now kind of predicting it's going to go to 4.5%. So some of these products that clients are taking out are only kind of 0.5% above base rate or 1% above base rate, whilst fixed rate mortgages for some of the clients are higher than that just now. So they're willing to take that risk, but obviously it is a risk, and nobody's got a crystal ball on what's going to happen in the next year or two. A lot of people are forecasting potentially that once we're into recession and once inflation is under control, they might want to either kind of keep the base rate there or maybe reduce it again to help stimulate the economy. But again, these are all just predictions just now. But generally, most of the clients are going for shorter term products just now, typically sort of 2-year products, rather than going for a mortgage over, say, 5 years and be locked into that deal and the inflexibility that that has, and maybe want to review things again in sort of 18 to sort of 2 years, 18 months to 2 years time, when hopefully things might be better. But again, there's no crystal ball on that. So my predictions in the property market in general, I've already seen the property market cool down. In my local area, it's probably cooled down around sort of 3 months ago, actually, earlier than other areas. All areas are different. Some areas are still kind of quite strong and just starting to slow down. Other areas, like my own area that I invest in, has been slow for a while now, actually. So I invest in Dundee in Scotland, and I saw the market starting to cool down. Definitely around sort of 3 months ago. As a business, purchases are definitely down as well. Especially a couple of months ago, we was doing very few purchases. But again, that's started to pick up again now. Clients are starting to understand where the market is, where mortgage rates are at now, and they're able to use that as a negotiating tool as well. Whilst interest rates were quite low and the property market was very buoyant, we saw a lot of properties going for way over their home report value. Now, with the market slower. And people understand where the kind of the interest rates are as well, they're potentially able to negotiate some deals. Some sellers are wanting the property sold for, sort of Christmas time into the new year. With there being less buyers in kind of the marketplace, they're not getting as many offers. So some people are willing to take a lower offer than there was previously. So some of our clients are actually, able to get some deals below home report, which is good news as well. A lot of people are waiting for next year though as well. A lot of people are concerned about what the market's going to be like going into next year, and wanting to just really hold off and see what happens. Maybe sort of Q1 of 2023, and then re-enter the market there. For myself personally, I'm actually quite excited as a property investor going into 2023. I find it quite difficult to buy properties over the last couple of years when the property market has been quite buoyant. Not to say difficult, that's probably the wrong word. The property deals have been there, but because the market's been so buoyant, they've kind of gone way over what I would like to pay for the properties. And now that I'm seeing the market starting to slow down, I'm starting to see more properties being reduced or going to fixed price. I can see there's negotiating opportunities there. So for me as an investor, I'm more excited about 2023 than I have been about the last couple of years. From a lender's point of view, as I mentioned before, they are starting to slow down. So what I think that will happen as well is they'll reduce their profit margins. Even over the last couple of months, we've seen quite high interest rates, but the lenders were still super busy, so they weren't really incentivized to reduce their rates down. But I think if we see the market start to slow down and they see a drop in applications, then we might see them start to reduce their profit margins, and we'll see rates reduce, and they already are ultimately reducing just now. We might see some more flexibility in criteria. We're already seeing that some lenders offering new criteria, just as a way to kind of create more market share, to get more applications in. Especially for those of you investing in Scotland, there's not that many lenders available up here. And a problem that we've had over the last couple of years is minimum loan sizes or minimum property values, where investors are typically buying properties below 100,000. There's not been that many lending options available for you. I'm predicting that we might see some of these lenders come back into that space that were there before. So we had some sort of specialist lenders that were lending with a minimum loan size of 25,000, a minimum property value of 50,000. At the moment, there's very few lenders in that sort of space. So it'd be great to see some of those lenders return, especially now that interest rates are higher. These high cash flow properties will be, most likely preferred over the low yielding ones. We have seen some concern from some of the lenders in regards to the Scottish market with what's going on. What Nicola Sturgeon announced about the rent freeze and the eviction ban. For instance, Paragon, they've limited the LTV on Scottish properties to 70%. We've seen some other lenders like Shawbrook say that they're potentially looking at what the situation, and if the rent freeze is extended, then they might, add additional criteria in there. So it's something to bear in mind if you are investing in Scotland just now. Um, Thanks, Jim, for the comment. So today's announcement expected shouldn't hold anyone back if your numbers are right. So yeah, I agree with you as well. And ultimately, the lenders expected this as well. So we've not seen any lenders yet increase the rates off the back of this. And so yeah, and ultimately the stability of that increases. The fact that even the lenders were expecting this helps them price in their fixed rate mortgages, as I discussed already. So thanks, Jim, for your comment. Right, guys, that was all that I had to say in regards to the mortgage market update. I just wanted to kind of cover off. On the 4th of January, me and my co-host Neil Dimmock are doing a Dundee property meetup. We've got a great speaker lined up. We've got Ron Smith. He's been in the property market for a long time, very experienced. He's also involved in new builds, involved in kind of being an angel investor as well. So, and also has some strong opinions in regards to the property markets. I'm sure he'll be giving his predictions for 2023. And I think it's a great way to start your new year. A lot of people have goals for 2023 when it comes to property. So a great way to do that, to kick it off, is to go to like a property event like ours, where you can meet like-minded people, chat through, what you're looking to do, and network and ultimately make those connections. Right, guys. Well, I've given my predictions already. Jim, so yeah, how do I see this affecting fixed rates? So ultimately, I think fixed rates, we'll see them drop actually off the back of this. Even this morning, we had some lenders reduce their fixed rate mortgages. Yesterday, we did as well. And like you said, that they were expecting this base rate increase as well. So I think we'll see further drops on fixed rate mortgages. And ultimately, the lenders do want to lend just now, with them seeing a drop in applications, and especially going into 2023, we might see lenders reduce those fixed rate mortgages. And also, another thing that I didn't comment on earlier is that a lot of the lenders have targets as well to meet, and a lot of them have met their targets for 2022, so they're not really that incentivized to lend at the moment. So there's not really kind of the need for them to reduce their rates down. But I think going into 2023, they're going to have new targets in place. Speaking to a lot of lenders just now, they've got quite high targets, quite ambitious targets. So I think we'll see them kind of really driving this into January, with sort of better products, lower rates, hopefully for us as property investors. Right, guys, first time I've done this live for a long time. I hope you like that. A little bit nerve-wracking for me doing it live. Usually I do sort of pre-recorded events. But going forward, if you do like it, I can do them once a month, or even earlier than that if you prefer. And we can maybe get some other speakers on as well to give their views. But if you do have any other questions, feel free to drop me an email. My contact details are below there. Give me a follow on social media on whichever platform suits you. I'm on YouTube, Facebook, LinkedIn, Instagram, pretty much everything. My main job is as a mortgage broker, but I also invest in property too. And really, I just like to give content out there for clients, ultimately to then be able to make the decisions when they look to buy properties. Right, Jim, you got another question as well. So you get a fixed rate commitment now, will you get a reduced rate later if it goes down? Yeah, it's a good point. Well, potentially, depending on the lender. If you lock into a product just now, certain lenders will allow you to change that product, but only up until completion. So let's say if you apply for a mortgage just now and the rate's higher and it takes a couple of months to complete, within that couple of months, you're potentially able to reduce that rate down. Not all lenders, some lenders, as soon as you apply for it, you're locked into that and you'd have to resubmit on that lower rate. But the majority of lenders allow you to change the product, through the application. But as soon as you've completed and drawn the mortgage down, then it's too late at that point. So bear that in mind. Some lenders are also saying that up until the mortgage offer is through, you can change the product. So the mortgage offer through, might come through quite quickly. So yeah, it's something to bear in mind just now. Right, Jim. Well, thanks for the comments as well. Yeah, each their own cooking, exactly. So, and ultimately, I've got mortgages going through just now as well. So I'm in the same boat as you guys. And ultimately, that's why I'm here to advise you guys. Because it affects me as much as it affects you as a property investor. All right, guys. I'll leave you two for the rest of your days, and thanks for watching me. Bye bye.